Hi, it's Alan Laubsch with Financial Network Analytics, and welcome to F&A Correlations. Today I'd like to focus on precious metals, gold in particular, and continue the conversation about whether gold is losing its allure as a safe haven asset. So what we saw yesterday was that the whole commodity complex surprised to the downside, but especially precious metals, so silver, gold miners, and gold, which are clustered very closely together here, showed a significant outlier move. Silver underperformed by 2.5 standard deviations, gold miners by over 2 standard deviations, and that was a 7.8% plunge, so pretty significant move there. And gold dropped by 1.8 standard deviations, alongside with broad equities and broad commodities. So obviously, gold has not worked very well as a flight to safety haven to shield investors from negative equities. In the opposite actually happened. The plunge was exacerbated there with gold, and we can see once again that the most reliable safe haven asset was the US 20-year government bond, which appreciated by over 1%, and you can see that this negative correlation is negative 0.63, and it's remained very close to the peak negative correlation of negative 0.66. This means that 20-year government bonds are the most reliable antidote to broad equity markets plunging. The second red link here that indicates a red correlation is the Japanese yen. That also has a negative 0.61 correlation, fairly stable, although yesterday it did not appreciate significantly. So by far, the 20-year government bond, certainly for international investors, was the best protection, while gold offered no protection to the broad equity market decline that we saw, which really was precipitated by, again, a weakness in commodities broadly and the entire oil complex. So we can see how that sort of filters through this entire complex. We can dig a bit deeper into gold and just look at the correlation structure. So you can see that gold still is negatively correlated to many equity markets, but that correlation is weakened. So the correlation to financials is now negative 0.32 from a peak of negative 0.57. To Japan, it used to be a very strongly negatively correlated. It moved from negative 0.63 to negative 0.28, and a very similar trajectory to Chinese large cap stocks as well, where correlation has moved from negative 0.62 to negative 0.28. So still statistically significant, but not a protection that you can rely on. And you could easily see the correlation moving positive again to equity markets if this trend continues. So given where gold is now in this territory, it still qualifies as a portfolio diversifier. There is still a strong link that's negative against the US dollar, although silver is more negatively correlated. So if you're concerned about the dollar weakening, silver and gold could be a good bet. However, if you are looking for a flight to safety asset that will protect a risky asset portfolio of equities, then look to the 20-year government bond as a much more reliable safe haven asset. Thank you for listening and watching. This is Alan Laubsch, and feel free to email me at alan@fna.fi if you have any questions or suggestions for additional themes. Thanks very much.